Most people assume the global economy is run from Washington, Brussels, or maybe Wall Street. But in recent years, another group of countries has been quietly trying to reshape how global finance works. Not with tanks or trade wars, but with development banks, payment systems, energy deals, and a growing list of countries asking to join. That group is called BRICS. And if its influence continues to expand, it could affect everything from infrastructure funding to energy trade, from currency reserves to the balance of power in global finance itself. BRICS originally stood for Brazil, Russia, India, China, and South Africa. The term was coined in the early 2000s by economists who noticed these large emerging economies were growing faster than much of the developed world. Over time, the label evolved into a political and economic coalition. Together, these countries represent more than 40% of the world's population and a large share of global production, commodity output, and energy consumption. They also sit at the center of many of the world's fastest-growing trade corridors. From the beginning, the group's goal was not to dismantle Western-led institutions outright, but to balance them. For decades, global finance has revolved around institutions created after the Second World War, the IMF, the World Bank, and a trade system, largely anchored to the US dollar. These structures helped stabilize global growth, but they also concentrated financial influence among advanced Western economies. BRICS emerged partly as a response to that imbalance. One of its first major steps came in 2014, when it launched the new Development Bank. The bank was designed to finance infrastructure and development projects across emerging markets. Since then, it has approved tens of billions of dollars in financing for transport systems, renewable energy, urban infrastructure, and water projects across Asia, Africa, and Latin America. Alongside it, the group created the Contingent Reserve Arrangement, which is a shared pool of financial resources meant to help member states manage short-term liquidity pressures and currency stress. But in recent years, BRICS has expanded beyond institutions into a broader geopolitical platform. Several countries have formally expressed interest in joining or aligning with the group. Among those that have pursued membership or signaled strong interest are Saudi Arabia, the United Arab Emirates, Iran, Argentina, and others. Some of these countries have already been invited into the expanded BRICS framework or continue negotiations and cooperation talks. Additional countries, including Indonesia, Turkey, and Kazakhstan, have also explored closer ties or potential future membership. Interest has come from across regions, reflecting a wider trend. Many emerging economies want more influence over global lending rules, trade systems, and financial governance. This growing interest is not only political, it is also economic. Many of these countries are major energy exporters, strategic transit hubs, or fast-growing consumer markets. Their participation could expand BRICS' role in commodity trade, infrastructure development, and cross-border investment flows. Payment systems have become another area of focus. China has expanded its cross-border interbank payment system to support settlements in yuan. Russia has strengthened domestic financial messaging infrastructure after losing access to parts of Western networks. India has promoted local currency settlement agreements with several partners. These efforts create alternative financial channels that can operate alongside existing dollar-based systems. Energy cooperation is also central to the group's agenda. Several BRICS members and many applicant countries are among the world's largest producers or consumers of oil, gas, and critical minerals. Discussions have included using local currencies in energy trade, coordinating infrastructure investment, and strengthening supply routes linking Asia, the Middle East, and Africa. Gold has quietly become part of the picture as well. Some BRICS central banks have increased their gold holdings in recent years as part of broader reserve diversification strategies. Gold does not depend on any single country's monetary policy, making it attractive during periods of currency volatility or geopolitical tension. It does not replace financial infrastructure, but it can provide strategic flexibility. Despite this growth, BRICS is not a unified bloc in the way the European Union is. Its members differ widely in economic structure and strategic priorities. China is a manufacturing powerhouse and the world's second-largest economy. India is a fast-growing technology and services hub. Russia is a major energy exporter. Brazil and South Africa play key roles in agriculture, mining, and regional trade networks. The interests of newer or aspiring members add even more diversity. This diversity limits how quickly integration can move. It also means BRICS functions less like a formal alliance and more like a coordination platform where emerging powers align when their interests overlap. Still, its influence is growing. As global debt rises, supply chains shift, and geopolitical tensions reshape trade routes. Countries are increasingly looking for alternative financing channels, development institutions, and payment networks. BRICS institutions and expansion efforts offer one such pathway. The significance of BRICS is not that it overturns the global system overnight. It is that it reflects a deeper shift already underway. Economic growth is becoming more geographically distributed. Financial power is less concentrated than it once was. Trade networks are evolving, and more countries want a voice in shaping the rules. BRICS is one expression of that transition. It does not replace the dollar system, but it reduces its exclusivity. It does not dismantle global institutions, but it builds parallel ones. And it does not represent a single unified vision of the future, but it signals that the balance of economic influence is gradually changing. And when that balance shifts, the architecture of global finance often shifts with it. If you value historically grounded analysis of markets, infrastructure, and systemic risk, consider subscribing.